Hello, and welcome to another episode of A Matter of Interest, a podcast by MoneyFarm. I am Jack Amy.
And I'm Richard Flax.
So, Richard, we have seen another escalation in the Middle East, followed by a bit of a pause this weekend, and it's the 27th of July, 2026. What has happened so far? What, more accurately, has changed over the last couple of weeks, and how is it impacting markets?
Sure. So, as you say, the conflict has heated back up again. The Houthis have become involved as well, so more actively involved. So there is kind of greater tension in different parts of the seaborne trade, and that has had an impact on the seaborne oil trade, where if, the Straits of Hormuz was, say, 20-25% of seaborne oil, the Bab el-Mandab Strait is around 5 to 10%. And so more of the oil is being forced around the Cape of Good Hope, which is obviously a much longer trip and adds, a couple of weeks to the journey time. And so that has implications for the oil price. We've seen the oil price rally. And again, by extension, it raises concerns among investors about what potentially will happen to headline inflation in the coming months.
And sort of maybe how long that inflation will last for. So if this transitions from maybe a temporary exogenous shock that might work out of the numbers in a few months, over to something that might be a lasting inflationary impact that central banks then have to adjust their policy to combat.
Yeah, and there's the usual challenge here, right, which is that central banks are facing effectively a supply shock, but their basic tool, i.e. kind of interest rates, is really most effective, or perhaps only effective in dealing with demand. And so the usual question that gets asked is, well, at what point does a supply shock somehow bleed into underlying inflation dynamics and causing inflation, more broadly to reaccelerate? And that's the challenge that obviously faced during the start of the Russia-Ukraine conflict. And it's a similar challenge to the one that we think central bankers are beginning to have to deal with today.
So since February, we've seen oil hit kind of approaching $120, and that's Brent crude, hit $120 a barrel or there or thereabouts. Do you think that this is going to be the sort of top of the range for oil this time? Do you think this pause might continue? Or given the usage of strategic supplies that we've seen over the past few months, do you think that there's maybe a kind of a right tail event where oil could go past $120 and hit a very painful point for consumers of any energy products?
Yeah, look, it's a super interesting question because actually if you go back to where we've been between, say, March and June, one of the surprising pieces wasn't that oil prices went up, but that they didn't go up more. And some reasons were put forward, that there were, release of strategic petroleum reserves from a range of countries, that there was, kind of demand management in countries like China. And so, you saw the oil price go up, but, to a, quote, manageable level. And then, as signs of hostilities, the situation improved, that the oil price actually came back down relatively quickly, at least the price on the screen. It is interesting to know that if you look at some measures of petroleum product prices, that what gets called the crack spread, that has stayed relatively elevated, suggesting that, for petroleum products, the fact the oil price went down didn't necessarily move the needle there. But if we see a sustained increase in oil prices because the conflict continues, as you say, the question is, does that mean that oil prices, move to a sustainably higher level? And were the relatively controlled increases we saw in the March to June period, does that become an anomaly and actually see, sustainably much higher oil prices? Look, I think our current thinking is no. We think that, there is a certain interest around the world to manage the conflict. And so we've already begun to, as you say, see some of that over the weekend, if that continues. But obviously it's a very difficult thing to call. And we've seen re-escalation already. I do think you see demand destruction. People drive less. People change their driving habits. So there is the potential there. But obviously, if you see a really sustained supply shock for an extended period of time, you will see oil at a sustainably higher level, and that does have implications. But do we expect to see oil prices way out of line with what we've seen over the last 20 years? We probably not.
Great. That's really interesting. So switching topics a bit, we've had a new Prime Minister in the UK. So Andy Burnham's been elected leader of the Labour Party and therefore has been sworn in as Prime Minister. He started off with a few policies. There's been a cut in VAT for some hospitality businesses, as well as some action on VAT on electricity bills as well as an interesting policy to move at least some of the governmental organisation into the north of England, so a number 10 north. How do you think that might impact the way that investors view the UK economy and also UK assets?
Look, obviously it's extremely early days, and I appreciate that the Labour Party has obviously been in government, but this is a new Prime Minister, and even if he was expecting to become Prime Minister for some time and will have made some plans, it's not the same thing as being able to, launch a raft of, very profound changes in a short period of time. So he's made some headline changes. I think in the scheme of things, they don't move the needle very much for kind of fixed income investors in looking at the UK. But, there are obviously a bunch of ongoing questions that, the Prime Minister and his new Chancellor will need to deal with. First and foremost, the UK is, as with many other developed economies, faces some challenges. The economy is not growing as fast as it would like. Tax burden is already relatively high. There are some fiscal rules that the Prime Minister and his Chancellor have said that they will keep to. But at the same time, Burnham has come into office on the back of a desire from some parts of the Labour Party to increase spending and increase government support for households in the country. And how you do that is not super clear. If you leave income tax and national insurance alone, as you've sort of said that you will, in all likelihood, we'll be looking at some other tax increases, be it on capital gains, be it in something to do on property. And that will leave households and potentially investors a little bit uncertain. As I say, but again, how you come out on that depends a little bit on your starting view. If you think that the economy is, as I guess I at least do, that the economy is really relatively highly taxed, and that the best solution is to try and find stronger sources of stronger growth. It's easy to say, it's very difficult to do. A lot of people from all parts of the political spectrum
have been trying this for a very long time,
and so to gaily announce that if only you could accelerate growth, it would all be much easier. I mean, not super straightforward, right? And I don't think Burnham denies that, and is presumably busy discovering it in much more detail than he did prior to becoming Prime Minister. And it takes time, right? You can raise taxes relatively easy. You can change interest rates if you're a monetary policymaker relatively easily. But, to put in the structural changes needed to accelerate growth is a multi-year event. And so that's a challenging process. And it's exactly the same set of challenges that his predecessor faced and the predecessor before that. So nothing new in that sense. What does it mean for fixed income investors? Well, look, we've seen government bond yields, say the 10-year gilts at around 5%. I think that there is some sort of political risk premium in that. UK inflation is high, but notably has actually come in, headline inflation has come in lower than expectations for each of the last 3 months, which is an interesting situation. The labour market, wage growth is above inflation, which is good, but decelerating kind of job vacancies have come down a little bit. So, the inflation picture is challenged as a result of the Middle East. But, there are other sort of slightly more positive metrics from an inflation perspective that you could point to.
I was going to say, it's worth sort of noting there that, yes, yields have hit 5%. They've kind of come a bit lower, and this is the interest rate paid, and we're looking here at the 10-year bond. It's probably worth noting. They've not gone up as high as they have been in the last couple of months. So there's almost certainly a sort of political uncertainty premium in there. But do you think there's much of that? Is most of the action that we're seeing on longer dated government bonds coming from the situation in the Middle East and the expected path of central banks? So in the UK, you're pricing in maybe 2.5 hikes and up until the middle of next year. Do you think that's the larger contributor to higher interest rates paid by the government? Or is there an element of uncertainty still from investors on what the UK government might do, and that's why the UK pays a higher rate of interest than, say, Germany or the US?
Look, I think a couple of points, right? Firstly, Germany and the US are very different
Yes.
in terms of their kind of policy situation, political situation, and geopolitical situation, right? US has a benefit from its kind of status and as a sort of anchor of the global financial system. Germany has much better fiscal metrics at this point than the UK does. The UK, on a relative basis, a sort of a small open economy, and global investors don't need to be there in the way that, frankly, they do need to be there in the US. So I think it's a combination of the two. Look, I think that, there is, at least from my perspective, Burnham has been, brought into office on the back of a desire to be more Labour, for lack of a better way of putting it, and to find ways to spend more on a range of policies that are, socially maybe very, very valuable. the question remains the same as it's always been, which is how are you going to finance that, and how much are the people who are going to lend you the money, how much are they going to charge you? And if you're a small open economy and you're not growing that fast and your debt to GDP is high but not outrageously high, then you're going to probably, you're going to have to pay up a little bit for that. And that's sort of what we've seen. At the same time, obviously inflation is higher than the central bank would like for largely for reasons of the oil price. And so there is potential there that if you do see a longer term resolution, the oil price comes back down, then you potentially could be in a better situation with regard to your yields. So I think it's a combination of the two. How you precisely split it out is not super straightforward, but it's not just going to be a case of, if the conflict in the Middle East is resolved and the oil price heads down towards $70 a barrel, then all of this will be solved. I don't think it's unfortunately as simple as that.
Okay, and then last point on this, at least from me, you mentioned there that there's this expectation that there's going to be more spending, but Burnham's made maybe a more conservative choice for Chancellor and John Healey relative to, say, Ed Miliband, who'll be the Foreign Secretary. And I think the IMF mentioned recently in their Article 4 comments that the UK set of fiscal rules seem to be kind of very, very sensible and seem to have them on the right path. Do you think the new Prime Minister is hedging his bets?
Look, I think that the choice of Healey, who I guess was not universally popular within the party, reflects some of the realities that that the Prime Minister has to deal with. By which I guess I mean that investor sentiment matters.
Yes.
If you are if you're asking them for money. If your choice of chancellor, even though the hand that they have to play is exactly the same, if your choice of chancellor is deemed to be pro bond market or pro-fiscal kind of, conservatism, however you want to put it. And if that's worth 10 basis points to you, well, that's actually money that you can then spend.
Yes.
It costs you less to you spend less on interest payments than you otherwise would have done. And that has some value. Now, the challenge, of course, is, well, how does your choice of chancellor really change, the decisions that get made? Because there is a school of thought that said, one reason why you pick Healey is because you will have less disagreements with him than you might have done with somebody else, and that, some of the conflicts between number 10 and number 11 that we've seen in the past will be less relevant or less likely. And so then the Prime Minister perhaps keeps more control over fiscal spending than he might otherwise have done. So I think, on the margin, the signalling is positive and the signalling matters. But again, once the dust settles on the appointments, the challenge is still your economy isn't growing as quickly as you would like. Your fiscal rules kind of keep you kind of moving along, but not necessarily achieving either goal of, spending more for the most disadvantaged in society, if that's your goal, and, changing the fiscal dynamics of the country in a positive way. You're sort of trying to, you're threading that needle between the two of them, but not actually necessarily achieving either. And that perhaps is the greater challenge to face. Before we continue, a quick note about MoneyFarm. We're a digital wealth manager with a simple purpose: to combine passion, expertise, and technology to give clients the 3 building blocks of investment success: access, advice, and low cost. Today, we help people manage their wealth through investment portfolios, pensions, ISAs, cash savings, and self-directed investing. All accessible through our platform and app. Whether you prefer to make your own investment decisions or receive expert guidance, our services are designed to support you at every stage of your financial journey. Alongside our team of investment experts, clients can also access Bastion, our AI-powered agent, which provides personalized insights and clear, accessible guidance to help them make more confident financial decisions. As always, remember that investing involves risk. The value of investments can fall as well as rise, and you may get back less than you invest. The views expressed in this podcast should not be taken as advice. Now, back to the conversation.
Great. So we will see how that progresses. Switching focus to something else again, we have seen the beginning of this quarter's earnings season from US companies, and we've seen a bit of volatility, particularly surrounding tech names. What's going on in US S&P 500 earnings and US kind of NASDAQ earnings, and how has that led to a bit of jumpiness around markets?
Yeah, so there's a few points to make. I guess firstly we should remember that that equities had a pretty strong first half of the year. Particularly out of the tech space, as you saw these very strong earnings growth kind of come through in some of the hyperscalers, in some of the in some of the suppliers. So I think that's an important kind of context to have. And you saw, I would say, also earnings expectations rise significantly over the first kind of 3 or 4 months of the year in terms of what sort of earnings growth analysts expected for 2026, versus what they expected at the start of the years, and those forecasts have risen significantly. At the same time, you've begun to see the sort of second quarter earnings season, as it gets referred to. You've had about 25% of the S&P report. And so far, those companies have generated earnings growth of around 38% year on year in the second quarter, which is a really strong number. It's the fastest growth since the third quarter of 2021, when the economy was kind of rebounding back from COVID. And they're really true drivers for the most part. One is energy companies. Obviously, the oil price went up a lot, those companies most exposed to it. And there are some large energy companies in the US. They've seen really strong earnings growth. And the other was in the tech space, as you say, particularly amongst the sort of AI complex, right? Either the provider of large language models or the listed providers and their suppliers. At the same time, you have a couple of things. One, expectations have gone up a lot. You've seen the strong performance, so perhaps a pause is understandable. But the other is this sort of ongoing question about, will all of this spending ultimately generate a decent return for these companies or for investors? Hyperscalers, the so-called hyperscalers are spending, enormous amounts of money building out data centers, building out infrastructure for this AI, ongoing AI boom. And the question is, how will they charge for it? Will they earn a decent return on it? And will their customers benefit from the services that these AI businesses will deliver? And that uncertainty is I think part of what has driven some of the volatility we've seen over the last few weeks.
And just to put a number on that, I think this has been widely mentioned. We've probably discussed it before, but you're looking at CapEx, so capital expenditure from these companies of around $700 billion in 2026. So a really, really, really large number. And if we look at Alphabet, so the company, the parent company of Google, they've actually gone free cash flow negative for the first time since their IPO this quarter. So the trade-off you're talking about is now kind of impacting them to the extent that they're not bleeding cash, but they are choosing to forgo cash now for the future. How quickly do you think that they need to show that there is a payback to that investment in order to get kind of investors back on side, or at least to placate their nerves?
Yeah, so a super interesting question, right? On the one hand, these are enormous, highly cash generative, or have been highly cash generative, profitable businesses. If you didn't care about the share price, we clearly do care about the share price, you could do this for a very long time. But I think that, investors within the next 6 to 9 months will be looking for signs, or at least the direction of travel is towards, managing your CapEx spend, seeing a return on that investment come through, seeing products and services that your customers are happy to pay for. So I'll give 6 to 9 months as a decent guess. And you could say the market volatility is telling you that investors want to see that sooner than that. I'm not sure that's the case, right? You've seen, these stocks go up. You've seen really strong growth come through. One of the things that I do think about, which perhaps gets less play, is around, this difference in expectations between companies and investors, right? Investors, we're looking for return on this cash flow, on this CapEx. But if you're a company in this space and you're concerned that your core business might be competed away, you're going to spend an awful lot of money potentially to try and rectify that. You might not be as concerned about generating a short-term return because you say, well, the alternative is existential, and that isn't something that gets talked about a huge amount. But I do think there can be this mismatch in expectations with investors looking for a return in the relatively short term, and I would say 6 to 9 months is the relatively short term, versus company management looking at the competitive dynamics in their industry and saying, the cost of not doing this is much higher than people appreciate.
That's interesting. The risk being skewed to the downside, where someone might come in, and we were speaking about Alphabet, who's, I think, roughly 3/4 of their revenue come from search, and maybe that business doesn't exist in 5 years' time, and therefore all of those earnings might not be there.
Look, I mean, but it comes back to obviously the discussions that people have been having about software businesses over the last over the last few months. Software businesses have been hit very hard, and the expectation or at least the potential risk that their customers might be looking to rationalize their services because they can do more in-house or they can do more with AI, or in the most extreme case, they can vibe code their way to sort of disintermediating a core piece of software. Those concerns, some of those concerns are probably valid, but in all likelihood, you would say that over a relatively short to medium term time horizon, they are perhaps a little bit overblown. Now, where they might not be overblown is that they do change the pricing dynamic.
Yes.
Where, you say, well, look, I'm going to continue to use whatever the software package is, but I'm not so willing to accept above inflation price increases you've put through every year for the last decade. And the dynamic of that particular conversation is going to be different.
So the available profit pool stays more or less the same, but where it's directed might shift.
I think that's fair. But I think that, and again, it these sorts of things often get overblown, right? They're sort of, software businesses are unlikely to disappear in the next 5 to 10 years, I would guess. But the dynamics they have with their customers or the competitive threats that they face, those might change.
And it's also worth noting that I think maybe at the higher end of the listed software space, it's not just the technology or the software or the interface that they're selling. They abstract away other sort of business problems as well, like regulatory risk or customer data storage that regulators or lawmakers might suggest you need. So maybe those are overblown. But it is worth kind of bringing it back to that point of, are AI companies providing something to their customers where, and again, it's Alphabet's earnings that we referenced, but users of Gemini have hit 950 million monthly average users. I think OpenAI or ChatGPT are over a billion. So you're seeing a lot of people use this technology already. Whether they're paying as much as those companies want them to for it is a different question, but a very, very large proportion of everybody is using this tech day to day.
Look, I think it's, the adoption has been unbelievably fast, right? If you look back at, previous periods of adoption, the adoption of AI tools has been, however you want to define it, has been extremely fast. The challenge with the 950 million, in my view at least, is, well, how much are those people prepared to pay? Because at the moment you would guess that they are not paying the marginal cost, at this point. If somebody says, now you need to pay $100 a month or $200 or $300 or whatever the number is, at some point, a household says, you know what, that's nice and all, but
perhaps I don't need so many credits.
I'm not paying for that. And look, we've seen that in industries in the past, right? At some point, the cost of production comes down and it becomes affordable, and adoption goes up significantly. But the extent to which the amounts that we're talking about are so big, the kind of cash burn, as it were, is really fast. These businesses, not all of which clearly are listed, right? Obviously, the two biggest names in the space are not listed businesses, but their demand is very relevant for a number of listed businesses. That cash burn is a pretty relevant part of the conversation. And so you could begin to see pricing move up relatively quickly. And then the users, the customers of that, now have a tougher decision to make. Am I really seeing the value that I need to see? What do I need to see? What value do I need to see to justify this cost? And you begin to see some of those stories.
Might be incredibly valuable at $20 a month. At $100, it's potentially the trade-offs are more difficult. So switching focus, we've mentioned cash burn, but in terms of where those cash flows from these hyperscalers are going, we also saw very strong numbers from Intel, who are makers of semiconductors and chips, and we also saw Tesla CEO Elon Musk mention and thank Micron, another semiconductor company, for helping Tesla find some supplier chips. So the cash flows are still there, but they've been maybe generated and pushed towards the sort of baseline of the AI supply chain, as in companies that make chips, design chips, or are the baseline supplier for the data centers where these models are trained and housed.
Yeah. I think it's a really interesting theme. It's an interesting theme that has a couple of different parts. Firstly, as we've discussed possibly in the past, you have seen recently a dispersion in performance between the Mag 7 and the semiconductor space. If you go back a year or 2 years, they were quite tightly aligned, and in recent months that hasn't been, last couple of months at least, that hasn't been the case. As these the kind of concerns about hyperscaler spending has gone up, but as you say, and that spending has been directed at some of these semi names. These are businesses that are earning, at least at headline numbers, far more than they have done in the past kind of decade or so. They've seen a really profound change in their fortunes and in their income statement. To the extent, and you mentioned, the Tesla earnings call, to the extent that there are real supply constraints around memory, around DRAM, around semiconductors, and you've seen, as we mentioned last time, the increase in the price of a number of Apple products to reflect the fact that they were having to spend more for some of their memory chips. So all of this is interesting, and we kind of talked about, obviously, the picks and shovels argument. You go to the people who are, or the businesses that are building, the supplying all of these names. That has a couple of implications for portfolios. One is around some of these names were relatively cheap at some point, right? On valuation metrics. The other is that a number of them are in emerging markets. You've seen emerging market equities view at least behave, much more closely aligned with the Nasdaq than has been the case in over, say, 5 years ago. But the other thing that's interesting about on the emerging side is if you look at a market like Korea, you look at the valuations in Korea, which are in some ways as low as they have been for a number of years, because investors, we think, are wary about extrapolating such strong earnings growth too far into the future. Even if you were optimistic about AI, as many are, you would still have to consider the fact that if in a supply constrained environment, you should expect to see more CapEx and more capacity being built in memory and in semis. And this has been generally regarded as a very cyclical business. And investors, if you look at, as I say, you look at kind of the price earnings ratio on the Korean market, investors are, those investors are telling us that, the cycle has not been suspended. These are cyclical businesses. There will be peaks and troughs. And even if you are at a higher level sustainably than you were, that cyclicality has not been banished for all time. But where you do end up is that, you can clearly see that the cash flow from the Mag 7 is being moved into, the companies that are building stuff. And they, are seeing much stronger profitability than they have done.
So I guess the question for the long term here, and from a portfolio perspective, is will that profit pendulum swing back? So if you do see more CapEx go to building out chip fabs and the production at that level of the supply chain, will the hyperscalers, these large tech companies who are building, or companies who are building these models, will the profit pool be redirected to them after you see this kind of supply shortage in semiconductors work its way through? Or is this a permanent shift and the age of the Mag 7 is done and it's now, we'll need a new acronym or name for semiconductor stocks? Yeah,
look, I mean, there's a few challenges, right? Obviously, the Mag 7 companies cover a pretty broad range. So talking about them in aggregate is sometimes can be a bit challenging, right? They are obviously spending aggressively now. You would expect that spend at some point to begin to taper off, and the cash generation that they have historically had to reemerge or reassert itself, hopefully at a higher level. You also are, I think we again continue to look for signs that that their customers, that their enterprise customers, are seeing the benefit of their AI spending. Right? It's all very well talking about the Mag 7 and the semiconductors, but if their customers don't drive value from their AI projects, then this will kind of, then this will not persist in the way that you might want. So what does that look like? Does that mean that we should expect to see stronger earnings growth and higher profitability outside of the Mag 7? Well, that would be the kind of, that would suggest that all the projects were worthwhile, right? Or some of them were worthwhile, and so that's sort of what you would hope to see. The challenge there, of course, is that, in some cases, earnings, corporate profitability is already pretty high. Are we saying it's going to go even higher? Perhaps. But, it's become more of a focus of attention politically and from a policy perspective, just how much, just what percentage of GDP is now coming from kind of corporate profitability. So that's another dynamic that might appear down the road. But look, you would expect that at the end of the day, you would expect that the Mag 7 spending aggressively now begin to see some sort of a return from that over the next kind of 6 to 12 months. The challenge for the kind of, the upstream manufacturers as well is whether they can collectively manage the sort of capital cycle to avoid a sort of a boom and a bust in, take your pick, whatever time frame it is, even in an environment where actually underlying demand remains pretty good. So, looking to see how much those companies really invest will become relevant. And then, they understand, right? They've been through this many times before. They're all wary of overcapacity and what that can mean. So hopefully we'll see some decent capital discipline. But the demand at the moment for their products is obviously off the charts, right? So they are incentivized to try and fill that as best they can. Well, that's all we've got time for today. Thank you very much for listening and hope to speak to you again soon.
Please remember that when investing, your capital is at risk. The views expressed here should not be taken as a recommendation, advice, or forecast. If you are unsure investing is the right choice for you, please seek financial advice.